All right. Good evening, everybody. My name is Mike Kayamori. I'm the founder CEO of Liquid. We are a regulated CeFi exchange in Japan, and we're in application Singapore. But today, it's about Curve and Michael. So, we have 30 minutes of, time where, to our audience, a lot of people are familiar, but for some, they might not know much. So we'll spend a lot of time understanding, Curve, Michael, the value proposition. And I think there's 5 questions that were brought up, in advance. So we'll try to cover all of them. First and foremost, let's start with, introduction. So Michael, thank you to, joining us today. And if you can, introduce yourself as well, your journey, and Curve, that'll be great. So handing it over to you.
Sure. Yeah. Nice to speak here. So basically, the journey was quite interesting because originally I started as a physicist. So I'm a physicist by education, and after doing PhD and postdoc, I actually went to Silicon Valley and was pretty much working in software for a little bit and founded a company called NewCipher. And actually in late 2018, I become a DeFi user, starting with MakerDAO, because MakerDAO works pretty much like a good lending protocol, and I didn't want to sell my precious ethers. But one thing I noticed is that exchanging between DAI and USDC, which was redeemable, was not very wasn't given a good deal all the time, because it just wasn't very effective on centralized exchanges, and even less so on decentralized exchanges. And at the same time, I was working playing with some trading bots. So I thought, oh well, actually, some similar ideas can be applied to stablecoins on chain, and that would solve my problem. So and that's what I did. There was also some inspiration from liquid staking ideas, which you can now see with staked ether pool, or in the RETH and some other staked ethers. And anyway, so in approximately September 2019, I came up with the algorithm for stablecoin swap and launched the first version in January 2020. And since then, it was evolving. So right now we are introducing some interesting algorithms for cryptocurrencies, which though need some, I would say, some experimental study. So that's what is happening right now.
Great. So obviously you have one of the largest, value locked up, one of the largest in the DEX in the DeFi space. But how is Curve different from other AMMs, and what are some of the similarities and differences?
Yeah. So at the time when Curve got started, the only AMM was pretty much Uniswap 1 with so-called constant product invariant. How it works, basically that one essentially rebalances the two assets, which is okay for very volatile assets. But for stable assets, it doesn't really make much sense, because you would have very small part of your liquidity actually working. It's because you kind of spread all the liquidity across all prices. So what we did, we concentrated liquidity in a narrow price range and did it in a kind of very smooth way, and that works pretty effectively and kind of proven to be a good bulletproof mechanism. Of course, there are some other projects now doing similar things, but yeah, we've been first doing that, and also later on secured this position with Curve DAO and CRV token economics.
Great. So I think you briefly mentioned you're expanding into cryptocurrencies, but Curve version 2, and how has it been doing, and your expansion into BTC. So if you can kind of elaborate a little bit more, that would be great.
Yeah. So we thought how to make effective algorithms for volatile pairs, and something we thought of is to basically concentrate a part of liquidity within a narrow price range, and other liquidity is pretty much following the constant product invariant, and you have kind of a smooth transition between them. And also moving this concentrated part around is actually associated with a loss. So we quantify how much profit we've got and how much loss do we get from moving this, and this way we figure out how much we can move this liquidity range towards the current price. And well, this is a very new algorithm. It's nothing like that existed before, so it definitely requires some study. So we've made some basically simulations, but simulations are simulations, obviously, and good thing is to do it to actually try it in reality. So we launched Crypto Pool actually before we had a very fast simulator, and Crypto Pool it's actually pretty interesting. It's sometimes, for example, right now it goes like extremely liquid, like doing really high volume relative to kind of old style alternatives. But when the price quickly moves, it takes quite a lot of time for it to kind of configure itself in a lossless way to start being that good again. And we've changed a few things to make it so that it's a little bit more even, like it's to do always better than kind of sushi swap or balancer, for example, but not as good as Crypto Pool right now, but better on average than it does. And yeah, so basically there is kind of migration of liquidity ongoing, but it's not yet kind of much in force. So I would say it's probably, I don't know, several more weeks until that happens to a new version. But yeah, that's a kind of we have some on-chain experimentation ongoing where we iterate on like how it works. Although like it's not overly significant changes. So it's like the main bulk of the work is like when we launched Tree Crypto for that. But there will be a lot of optimization work, obviously. And also we probably will, of course, deploy pools with different assets. So this one is with cryptocurrencies like Ethers, Bitcoin, and traded to USD. And there are two directions we want to look at, any like cryptocurrencies rather than just three main traded kind of to them. And also we want to look at trading stablecoins of different denomination to each other, like euros to USD to GBP to whatever.
So, I wanted to kind of follow up on your question when, you launch these new versions and, you do a lot of simulation and, analysis, and then you also, but it's a little different when you actually launch it in production. And how, are there like kind of different learnings or, like by that, what are the things that are, you learn from, versus your simulation and versus, actually launching it?
Right. One thing which is, I think which is very, very common for AMMs is taking into account Ethereum transaction fee. Because well, imagine this. Imagine that you have one place where you trade where cryptocurrencies were traded, and another one which you launch, right? Of course, not necessarily trades come through arbitrage, but arbitrage is actually a very good model of what's happening in reality.
Right.
And imagine that you are doing arbitrage of your new shiny AMM with I don't know, with something already existing, right? And if imagine that. Imagine like a sushi swap style AMM, where to move price by 1%, you pretty much need to trade, I don't know, 1% of the TVL, right? Well, it's actually a little bit different, but yeah. Let's say if your TVL is, I don't know, let's say imagine your TVL is 1 million, right? And you trade 1%, which is 10,000, right? It already moves the price by 1%, which is a lot. So for arbitrage traders, it's already not so interesting. But transaction fee on Ethereum, let's say it's $20. It's like 2% of that on top of the slippage you had. So it makes it like really even worse of a deal. So apparently this transaction price on Ethereum, it actually makes it hard for new entrants to launch their AMMs with low TVL. So for example, for Tree Crypto, the threshold when it starts working kind of as intended is 100 millions. So if it's less than 100 millions, it kind of doesn't quite perform on Ethereum, and that requires to care about safety really a lot, because if it's less money loaded up, it's not working well. But if it's a lot of money over there, then you need to really make sure that nothing gets lost. For that you have no bugs which do that, which can cause losses and so on. And that's challenging, yes. And also, you may think, okay, maybe you do audits and everything will be fine. Well, audits are good; they are necessary, but not always. Even best auditors can see everything. So you kind of it's really still up to developer. Even best auditors cannot find all the possible errors, just because to build something good, which is not just a copycat or something, you need to be a really good developer, and auditors are also really good developers. But you, as a good developer who created it, have much more context than they do. So you may notice many more things. And yeah, of course, a fresh look from them will help. But yeah, it's still up to the actual developer of the protocol to make sure everything is really safe. And Ethereum doesn't leave much of a choice but to have really high TVLs. And layer 2s and other chains are probably helpful to launch with smaller TVLs. For example, when we launched, actually the first one version specifically to test things out, we launched on Polygon, and the threshold TVL for it to work properly was not 100 millions, but actually 60,000. Much better for tests.
Interesting. So yeah, in real world, you need to look into these, gas fees and the TLVs and all those. So yeah, completely understand, where it comes. So I do wanted to ask more around, cryptocurrencies, and you were talking about new denomination, USD, euros, and all those. But this 15-minute time is already kind of ticking. So I think the audience will be very much interested in, the competitive landscape and, especially, Uniswap and, Uni V3. So, your take and how you're different and all these things will be great.
Yeah. So with Uniswap 3, it's actually interesting. I had a very similar idea when I was starting Curve, very similar to what Uniswap does, well, pretty much the same. But then I thought a little bit and thought that actually it's possible to do better. It's possible to do this fully automatic. In Uniswap 3, you can pretty much concentrate liquidity in a range from one price to a different price, right? And that works for speculators, I guess, because you can say, okay, I want to sell my coins from while it's going from this price to this price. Well, sell or buy, right? So when it goes up, you sell. When it goes down, you buy. But you can say, oh, actually, I want to stop doing that. I'm okay. And you kind of remove liquidity and you appear to be sold like, part of the coins. So that's like kind of continuous limit orders. That's what Uniswap 3 is, more or less. And that is possible to do to use for market makers. And maybe it is possible to implement trick crypto algorithm for that. But one thing is that it will spend quite a bit of gas on rebalances. And another thing is that I'm not entirely convinced that their kind of price step size is precise enough. Because it might be that you need something smaller, maybe. And also, there are, of course, liquidity managers for Uniswap 3, but I'm not sure they're doing well because, like, when there is volatility, they seem to be losing money compared to, let's say, if you had a Uniswap 2 pool. Although they may have a kind of support the deeper market and greater trading volume, but it's more often than not, despite this higher trading volume and fees, the loss is actually higher than what this trading volume makes you. And you need to do something like extremely challenging to make sure it doesn't happen. So it's just hard for a non-professional user to do that. So you kind of need professional market makers over there, more or less, or projects who take users' money and do professional market making, because it's indeed a good tool for professional market makers. And on Curve, we are trying to do it like fully automated, fully robotic, I would say. And one of the things is that we make sure that the loss doesn't actually happen. So it's like written in the pool's code. We just look what the profit is, what the loss is, and loss is not higher than half the profit, something like that.
That's very interesting. So let's see how the jury goes. So it'll be great to reassess this in another future conference or something like that. But we only have 10 minutes left, but there's a few more that we have to cover. And the next question is something that I'm very interested, as a centralized exchange licensed in jurisdictions like Japan. So how do you look at regulation in general? And then even today, I think was it Gensler in the U.S. was saying like these stable coins are, securities if their underlying asset is, securities. So if it's not only just, U.S. dollars, but money market funds and others, it's a security. So how do you look at, regulation from your product offering and your service?
Yeah. I think, there is definitely regulation coming. But I think that probably the first instance which they will touch is assets themselves. For example, there are redeemable stablecoins, right? And they may need to do something to comply. Well, they will be forced to. Maybe some issuers will have to become banks essentially, or they will have to keep it in banks, right? So that's probably one thing. But also, if we are not talking about stable coins, if we are talking about tokens which might be securities, well, I mean, if you have permissioned listing, then yes, you can kind of control that. But when it's permissionless, not much you can do. Of course, there is a question where the DEXs should be KYC'd, but I think that is, I think it is impossible to KYC DEXs. But what probably will happen over time, it's possible that redeemable stablecoins will be KYC'd, like even for transfers. I don't know if that ever comes to that or not, but that's a possibility. In such case, it's still possible to work. It's still possible to have decentralized DeFi, but it will be a little bit different in such case than what it is today, right? So, but yeah, we will see, because it will take time for regulators to implement that. And also, like, what exactly are regulators trying to achieve? Because, like, for example, if you take anti-money laundering laws, right? And yes, there is a lot of financial crime happening in traditional markets, and also like in the traditional currencies like US dollar, and a lot of crime happening in a stablecoin world. And so far, it's basically many criminals get caught when they do what they do with cryptocurrencies, and especially with stablecoins. So I think actually regulators may probably need to look at that more carefully and learn something about how to prevent crime, because I think that even currently in cryptocurrency world, crime is prevented better than in traditional banking world, like without KYC, right? So there is something here, I think. But so basically, they probably would need to work from the fundamentals, like what they're trying to do, and basically see if if it's banking which should be changed a little bit rather than crypto world.
Right. It's interesting. Is there something you are doing, like as Curve? I understand you were talking about, the stablecoin issuers might have to, get a banking license or, more, on their side. But from, specifically from your perspective as Curve, right? Is there something you're preparing or, doing, or are you more of wait and see?
Yeah, I think, well, there is, of course, some waiting, but what is clear is that it's much better to stay fully decentralized. And most importantly, if there is a possibility for developer to essentially plausibly take the funds, or replace the code in an upgrade to anything which could potentially take the funds. So that one is actually something which begs for regulation, right? If we put like user safety as the top priority, then there are two things here. One thing is, can the developer single-handedly take users' funds? And the other one is whether the code is actually safe to handle users' funds. So I think if in ideal world, it is quite expected to see that regulators would require either to have the code, if it's controlled by the company, right? Then there probably would be like all like KYC, ML measures, whatever, and also measures to prevent loss of funds, like, you know, reacting on things quickly, whatever. Or if the code is fully decentralized, then maybe it will be lighter requirements on like AML KYC side, because essentially nobody controls it. But also maybe more stringent requirements as to like how to ensure code safety. So it definitely will be harder to launch a new protocol, I think. But there is still, I think, a place for fully decentralized exchanges.
Yeah. I mean, it's going to be fascinating, right? And I think we're all trying to do the same purpose, protect customers' assets. But the way you approach it, from a traditional regulator perspective or law enforcement, is very different from progressive DEX and DeFi and how they approach it. So they're all trying to do the same, achieve the same mission, but the approach is different. So it's going to be
They will probably learn how to do that over time. So and well, they are looking at it. So maybe it's not always smooth, but they will like inevitably learn how to do it better.
Correct. And it's going to take time.
Yes, of course.
Okay. I apologize. We only have, 2 minutes plus, and, there's 2 more questions, but, the stable coins, I think you were talking about you were going to, start offering, foreign stable coins and all those. So yes. I do want to skip that and go to, what's also unique for you, which is, the VCRV and the convex CRVs and, the pros and cons and, how you look at that. If you can do it in like 1 minute, that'll be great.
So what exactly about VCRVs?
The advantages, pros and cons, or
It's basically VCRV is a way to have a voting power which you cannot quickly remove, so that you are financially invested in your vote. Like if you have consequences of your vote, then kind of you have a long-term monetary consequences of your investment, so you need to think well about it, and that's what it serves for. But it appears that this system works pretty well, and I probably wouldn't be able to tell more in these 5 seconds.
Of course, I apologize. I should have done better time management, but thank you so much for your time, and